Welcome to the Texas Aver Roth Option webinar. We're so glad that you joined us today. My name is Lisa Kazaku, and I'm with Employees Retirement System of Texas, and I just want to go over a couple of logistics about today's presentation. Everybody is muted right now, so the way that you're going to ask questions during the presentation is through the question chat feature. You're going to go ahead and type in your questions, and we'll review them as we go, and then we'll take a look at it in the end too to be sure that we get all your questions answered. We think that we will probably answer about 80% of all of your questions throughout the presentation today. But we're so glad we have so many people on the line that are so interested in our new Texas Aver Roth Option webinar. Now, ERS, we're the administrators of the Texas Aver program, but we hire Great West to be our record keeper. So I'm going to turn it over to our Great West representative, Lionel Zachary, who's going to go over in detail about the Texas Aver program. Lionel, you with us?
Thank you, Lisa. Welcome, everyone. And the purpose of today's discussion is to help you understand the Roth contribution option, how it differs from the traditional before-tax contribution, and how best to determine the options for you, which could be one or both, before-tax and Roth contributions. Next, I'd like to review the agenda. We'll only be about 30 minutes or so, and there'll be plenty of opportunities for questions, but we're going to look at the basics. We'll spend some time comparing the Roth option to the traditional before-tax contributions you've made in the past. We'll explore the contribution limits and the tax advantages, and we'll talk about qualified distributions, fees, and other features of your Texas Aver plan like loans, investment options, and rollovers, eventually helping you identify which choices are best for you. Finally, we're going to look at a Roth Contribution Analyzer, which is an online calculator that can help you to determine whether to save with traditional pre-tax dollars or with Roth dollars. This tool will be available to you on Wednesday, December 31st. So we hope that you'll visit our website and take advantage of it. So what is Roth? Maybe your first question. Well, Roth contributions allow you to contribute to the Texas Aver 401k and 457 plans with after-tax dollars. Rather than paying taxes at distribution, you pay them now. You could designate all or a portion of your contributions to the Texas Aver plans as Roth contributions. No taxes are withheld from Roth contributions or their earnings when the distribution is taken as a qualified distribution. So, repeating that again, the distinction between the Roth contribution and traditional contributions are that Roth contributions are made with after-tax dollars, traditional contributions are made with before-tax dollars. Some of you may be aware that contribution limits to the plan periodically change, and in 2012 the contribution limit for both before-tax and Roth contributions will be $17,000 in 2012. If you participate in both plans, the 401k and 457, that's a combined total of $34,000. You may be able to make additional contributions if you're age 50 or better, or within the last 3 years of your normal retirement age using the special 457 catch-up election. So you could actually put away quite a bit of money in a short period of time, particularly if you had a large sum of annual leave. So what would be the tax implications of choosing a Roth contribution versus a before-tax contributions? Well, Roth contributions reduce your take-home pay dollar for dollar because you pay taxes on your Roth contributions up front rather than when you take money out at retirement. In the illustration on your screen, we have an example of someone who earns $40,000 a year, and they're in a 15% tax bracket. They also contribute $100 each month before tax to the Texa Saver plan in the center column. So this person would have to pay income tax on $38,800. After taxes, your take-home pay annually would be $32,980. If that same $1,200 was contributed after tax as a Roth contribution, you would pay taxes on the full $40,000 you had earned immediately. And your take-home pay would only be $32,800. So just a bit of difference in how the taxes are withheld and applies to your contributions as pre-tax or as Roth. So we've talked about how the money goes in and what the limits would be, but we've got to talk about how the money comes out, and that is a qualified distribution. What is a qualified Roth distribution? Well, for the 401k plan, this means that it is generally one that is made after 5 taxable years of Roth participation and is made on or after an employee reaches age 59 and a half, after an employee's death, or is attributable to an employee becoming disabled. For the 457, the qualified Roth distribution also has a 5 taxable year period, but it also includes that they must be made on or after an employee reaches age 59 and a half and has separated service. 457 plans are going to require separation of service where the 401k plan did not. 457 also includes qualified distributions made after an employee's death or is attributable to their becoming disabled. So what is this 5-year holding period? How does it work? Well, the 5-year taxable holding period begins effective January 1st of the calendar year in which you make your first salary contribution as Roth contributions. So if your first contribution from your pay were to occur on July 1st, 2012, then calendar year 2012 will count as the first taxable year. Using this example, the 5 taxable year holding period will end on December 31st, 2016. You would include 2012, 13, 14, 15, and 16. In 2017, if you were disabled or to die or had reached age 59 and a half, separated service, your distribution would be qualified. If you make a direct rollover from another Roth contribution account with another plan, you may have already begun your 5-year holding period because it begins on the first day of the year you made your designated Roth contribution to the other plan. If that date's earlier than the date you start with Texa Saver, you're already ahead of the clock. Those current participants of the Texa Saver plan are already aware there are monthly administrative fees for participation in your plan. The administrative fees apply to both before tax and Roth contributions. So if we look at this example, we'll note that someone perhaps named Sarah has a $3,000 before tax balance. So Sarah would pay $3.99 per month in administrative fees. Her Roth contribution administrative fees would be charged separately. Because there are 2 money types held within the Texa Saver 401k or 457, you will have separate administrative fees for each money type in addition to a flat fee of $5 to participate in the Roth option. So if we were to continue our example with Sarah, she may have the $3,000 in the before tax, but she may have $17,000 in Roth contributions to her plan. She would pay the $5 flat fee for participation under the Roth and a $6.32 monthly administrative fee according to her account balance. Combined, that would be $11.32, but her total would include the fee she pays for the pre-tax contribution of $3.99, altogether $15.31. These fees are applied on separate days of the month and are displayed on your statements and on our website, so you could see them. The fees are displayed in two sections on your statement, and their account summary by contribution source and as transaction details. These fees are often offset by the reimbursements provided by several of the investment options within the Texas Saver plan. Texas Saver is a self-funded plan. Money is not contributed by the legislature to support the administrative costs. So it kind of works like a co-op. One of the most popular features of the Texas Saver plan is the loan option. And you may ask, can I still take a loan if I have Roth contributions in my Texas Saver plan? The answer is yes. Loan distributions are prorated from before tax and Roth contributions. Repayments are prorated back to each money type. In other words, as you repay your loans, the money goes back into your account exactly as it was taken out. But wouldn't they be taxed? Roth loans are treated just like the traditional loans. So suppose you have money in before tax and Roth contributions. The loan will be prorated by the amounts of money you have in before tax and Roth contributions. But so long as the loan is repaid in full according to the terms of your plan and the loan policy, you'll pay no additional taxes. Let me try to explain by giving you an example. Maria has made before tax and Roth contributions to her 401k plan. Maria has $10,000 before tax dollars and $5,000 Roth dollars in her Texas Saver plan. She takes out a $2,000 loan. Since the loans are based on the total plan balance, 2/3 of her loan, or $1,333, would come from before tax dollars, and 1/3 would come from her Roth contributions, $667, to create her $2,000 loan. George, on the other hand, may only have a Roth contribution balance. So if he takes a loan, all of his loan distribution will come from the Roth, and all his repayments will go back to the Roth. Now, some of the ways that you could quickly accumulate funds within your Roth or Texas Saver before tax contributions could be on your last paycheck. You could defer some or all of your annual leave as a Roth contribution to the Texas Saver plan as long as it does not exceed the current 2012 limit. But remember, you must have held your account for 5 taxable years to retain your tax advantage. You could also roll over dollars from other qualified Roth accounts. This would include 401k, 457, or 403b plans. Now you may ask, what about a Roth IRA that I started? No, you can't roll over an existing Roth IRA to your Texas Saver plan. Roth IRAs can only be rolled into other Roth IRAs. What if you had a Roth IRA from a prior employer? Would that be eligible for a rollover? The answer again is no. You can't roll over a Roth IRA from a prior employer-sponsored plan if it's a Roth IRA to the Texas Saver plan. Like plans must transfer to like plans. Well, what about the investments? Well, the securities provided in your plan are provided by GWFS Equities, Inc., and they apply the same to both your before tax and Roth contributions. You may think, well, wouldn't this be different? Well, no. You cannot select a different investment option for your Roth dollars than you have for your pre-tax dollars. all contributions are allocated to the same choices that you make in your plan. So let's kind of review some things very quickly. The big picture, comparing the differences between the Roth contributions and traditional before tax contributions. We've got a small chart. And the first question is, are the contributions taxable in the year that you make them to your Texas Saver plan? The answer for a before-tax traditional account is no. The answer for an after-tax Roth account would be yes. Remember, Roth contributions are made with after-tax dollars, whereas contributions to a before-tax traditional plan are made with before-tax dollars. Next question in the center of the screen is my contribution taxed when distributed? For before-tax contributions, the answer is yes. For after-tax Roth contributions, the answer is no. But what about the earnings on your contributions? Are they taxed when distributed? For before-tax traditional accounts, the answer is yes. For after-tax accounts, the answer is no, provided that it is a qualified distribution, meaning occurs after age 59 and a half, cause of death, disability, and has been at least 5 years since your first Roth contribution. If you meet these requirements, your distribution from the Roth is taxed and penalty-free. Now, somehow or another, you've got to feel confident that you're making the best choice for you. It's going to be a very unique decision. You'll have to determine whether contributing to your plan on an after-tax basis, before-tax basis, or a combination of the two makes more sense. The Roth option essentially locks in today's tax rates on all your contributions. For some people, especially those who might be in a higher tax bracket when they retire, the Roth option may make a lot of sense. If you're one of those people, the Roth allows you to pay taxes today while you know what the tax rates are, rather than risk what they could be in the future. If you expect to be in a lower tax bracket when you retire, you might want to consider contributing to your account on a before-tax basis. You won't pay taxes on your contributions or any earnings on your contributions until you've made a withdrawal. At the beginning of our presentation, I shared with you that there will be a new tool added to the Texas Saver website on December 21st. That's Wednesday of next week. We're going to put an online calculator called the Roth Contribution Analyzer to help you determine whether you should save in your traditional or under Roth 457 or 401k types. To access the calendar, you will visit www.texassaver.com and click on the Resource Center link. No password or PIN number will be required to access the calculator and the other information on this page. Then you'll go to the calculators and select the Roth Contribution Analyzer. Next, you'll input some information, such as your date of birth, your current salary, the amount of money you'd like to contribute, your expected retirement age, and how long you hope to live through retirement. Mindful that many of us could reach our late 80s and early 90s. You may be retired even longer than you worked. So after you've entered and confirmed your information, you want to press the Calculate button at the bottom right of the screen to view the comparison of your results. Based on your desired savings level and other information you've input, the tool will compute your retirement balance and expected income based on the available combination of traditional before tax and Roth combinations and display them in a table. The illustration will take into account some assumptions on the tax rates and rates of return that you may achieve, giving you some what-if analysis to play with. Regardless of which type of contribution you choose to make, The important thing is to contribute as much as you can today for your retirement tomorrow. The Texas Saver Plan is available to part-time and full-time state employees and select colleges and universities. Please check if you are a higher ed institution with your Human Resources office. If you're not currently enrolled in the Texas Saver program, you could elect to make before tax or Roth contributions online by completing an enrollment form or contacting one of our local education counselors. If you'd like more information about the Roth option, we encourage you to visit our website and look at our frequently asked questions, or call us. Our number at 1-800-634-5091. We'll even accept messages by email at texassaver@gwrs.com. We encourage you to attend our future seminars across the state throughout the year and wish you all the best of holidays. We'll ask Lisa